Two prominent Federal Reserve officials delivered an unusually blunt rebuke of the central bank's recent interest rate cut, arguing that inflation remains too elevated and the labor market doesn't require immediate assistance, casting doubt on further monetary easing in December. Dallas Fed President Lori Logan and Kansas City Fed President Jeffrey Schmid both stated Friday they opposed the Fed's decision to lower rates by a quarter point earlier this week. Their public criticism represents a rare display of discord within the central bank and suggests a higher bar for future rate cuts. Kansas City Fed Schmid wanted to hold rates steady this week on inflation concerns. Split decision reveals deep Fed divisions. The Federal Reserve voted 10-2 on Wednesday to cut its benchmark rate to a range of 3.75% to 4%, marking the second reduction this year. The vote featured dissents in opposing directions. Schmid opposed any cut, while Fed Governor Stephen Miron favored a larger half-point reduction. "I did not see a need to cut rates this week," Logan said in prepared remarks for a Dallas Fed banking conference Friday. "I would find it difficult to cut rates again in December unless there is clear evidence that inflation will fall faster than expected or that the labor market will cool more rapidly." Schmid, who cast a dissenting vote against the rate cut, warned that monetary easing could undermine the Fed's credibility on inflation. "A rate cut can have longer-lasting effects on inflation if the Fed's commitment to its 2% inflation objective comes into question," he stated. Inflation concerns drive opposition. The official's hawkish stance reflects growing unease about persistent price pressures. U.S. inflation rose to 3% annually in September, the highest since January and well above the Fed's 2% target. The rate has remained elevated for more than 4 years. Schmid noted that business contacts in his district express widespread concern over continued cost increases and inflation, particularly citing rising healthcare and insurance premiums. He characterized the current monetary policy stance as only modestly restrictive, despite inflation running at 2.8% according to the Fed's preferred measure. Logan emphasized that while the labor market faces downside risks, the remaining risks to employment are ones we can monitor closely and respond to if they are becoming more likely to materialize, not ones that currently warrant further preemptive action. The criticism comes after Fed Chair Powell warned Wednesday that a December rate cut was not a foregone conclusion, far from it, causing market expectations to plummet from 90 to below 60. Financial markets are now pricing in only a roughly two-thirds chance of another quarter-point reduction at the Fed's final meeting of 2025.